tax planning because it's one of the biggest risks and biggest opportunities right now.
Welcome to Barry's Bites. Please join our host, attorney and financial advisor Chris Barry.
Couple reasons. One is we have the Tax Cuts and Jobs Act that runs from 2018 to 2025, where in 2025, your taxes are going up across the board about 3 to 4%. Then we have the Secure Act that says your kids are taxed or your beneficiaries are taxed potentially more based on inheriting these IRAs. And then now we've crossed $30 trillion in debt. Prior to the pandemic, we're at $22 trillion in debt. And so first one is Roth conversions. So this is taking pre-tax money like IRA money, moving it to a Roth, which grows tax-free. This is tax deferred, meaning whenever you pull money out of here, you're going to have to pay the tax. And we know taxes are going up in the future. Roth money, this grows tax-free. Pretty straightforward. Most people are familiar with Roth conversions, but a lot of people get hung up on the difference between a conversion versus a contribution. There's no income limits on conversions. You can take $100,000 inside of your IRA, move that over to your Roth. Now you have $80,000 of Roth money if you wanted to. A more advanced strategy is taking your IRA money or 401k money, pre-tax money, paying the tax, and now moving it into cash value life insurance, typically index universal life. There's pros and cons to this. The nice thing about this is it's protected against downturns in the market. This could be more of a legacy play where you're leaving more to the next generation than, say, a Roth. Plus, also, we can build in some long-term care benefits. Relatively new strategy, but this is something that's available and we're talking to a client today about it, is what's called donor advised funds. You could use this for like highly appreciated assets if you're charitably inclined. We kind of run into issues because of the standard deduction being so high right now. But if you're itemizing and you're donating to charity, what we could do is lump some of those charitable donations together all in 1 year. And then we could itemize to be able to write off donations to charity. So maybe we put $30,000 into a donor advised fund every 3 years or so. And then from there, you can decide which charities you want this to go to. And then that would lower your income tax by $30,000 because of the charitable contributions. And then once you have RMDs coming on, whether it's 72 or maybe 70 and a half if it's an inherited IRA, then you can look at qualified charitable distributions. So this is where your IRA is going to force you to take out these required minimum distributions like we talked about before. But if you don't need them and you're charitably inclined, well, let's send these directly to a charity. And now this reduces your income and you don't even have to worry about the standard deduction. It's just coming right off of, instead of that RMD of say 20,000, 30,000 or more showing up as income on your income tax return. If we send it directly to charity, it doesn't show up at all. So that might be a good strategy as well. And then a little more complicated, a CRT or charitable remainder trust would be, okay, we're going to gift assets to the charitable remainder trust. The income that it generates can come back to you potentially tax-free, but then the principal upon death goes to a charity. So it reduces your income tax liability. And also we used to do a lot of these back in the past when there were estate tax issues. It also reduces your estate tax. So those are just some of the kind of core tax planning strategies that are available. And these aren't like you only choose one. A lot of times these can work hand in hand. Understanding the tax rules, there's certain things that we can do to put ourselves in a much more advantageous position. It's all about looking at taxes not through a micro lens of minimizing taxes in one specific year, but minimizing taxes for your retirement and what you leave to the next generation.